Welcome to this Magellan update, which is specifically put together for clients of Benchmark Financial Services who've been long-term supporters of our fund. Magellan's been providing exposure to high-quality international businesses for over 12 years now, and over that time, thankfully, we've been able to exceed our goal of delivering 9% per annum. We manage over $90 billion of funds for investors, just like yourself and many large institutions globally. We provide access to growing multinational companies that aren't readily available on the ASX, such as Google, MasterCard, Apple, amongst others. So we will now provide you with that market update, and whilst we're pleased to provide you with this update for Benchmark clients, please note the usual disclaimers and disclosures and contact David or Roseanne if you require any further advice. So Hamish, you've recently disclosed that Alibaba is an investment of the firm and it's in our top 5 holdings. Maybe talk us through some of the rationale for that investment.
Well, at the end of the day, Frank, we're looking for very high quality businesses that are supported by some very long-term growth dynamics behind them. And actually Alibaba ticks a number of boxes of thematics. First of all would be consumption growth in China. We have a number of investments that are aimed at that emerging middle class or upper middle class in China. They could be Starbucks, LVMH, which is a Louis Vuitton business, and now Alibaba. Why is the consumption growth story so important in China? You have to think about the pyramid of that sort of 1.2 to 1.3 billion people in China. It's estimated there may be 300 million people who are defined by income to be in the middle class. Maybe there's 600 people who are to 700 million who are urbanised at the moment, but 300 of those urbanised people are sitting inside the middle class. The total consumption growth in China is growing at 8 or 9% per annum. The estimates we see is the forecast increase of people who have middle class incomes is forecast to double over the next decade. That is 300 to 600 million people. That has actually been driven by urbanisation and the effects of urbanisation in the creation of wealth. It's estimated nearly 30 million people move from rural into cities each year in China. So that would kind of tell you about another 300 million over a decade. If you look at that, what is the growth in the value of that middle class consumption over a decade? That would be 7.5% per annum. As you start moving up this pyramid of incomes, it's estimated what is really known as the sort of the more affluent middle class. It's estimated the income brackets there may be 50 million people in that class who are going up the income pyramid. That is forecast over the next decade to maybe increase to 200 million people. That is an increase of 4 times or 15% per annum. So people who can consume up the channel of more valuable goods is growing maybe 15% per annum over a decade. And if you look at the very top of the pyramid, the sort of affluent consumer, not the middle class, but the true affluent, maybe that's around 10 million. People may say it's around 12 million consumers at an income bracket who could buy a Mercedes and that type of thing at the moment, that sort of very luxury sort of goods. It's forecast that that side of the economy may go up 6-fold from maybe 10 to 60 million people. That's a growth at 20% per annum. So what is Alibaba? First of all, it's focused on consumption. They have the largest e-commerce platform in China as its main business. They have 2 big platforms. One's called Taobao and the other's called Tmall. It's estimated there's nearly gross merchant value or sales on those platforms today approaching $900 billion US. That is twice the size of Amazon. Those businesses are growing above 25% per annum. They're taking market share. Already 15% of total retail volumes in China are done on those 2 platforms. So very, very powerful e-commerce business, but there's much more to Alibaba than purely just e-commerce and these well-known e-commerce platforms that we're interested in. The next would be payments. We've been very interested in payments for a long time, the digitalisation of the payments in economies. They have a 33% stake in Ant Financial, which is the largest digital payments platform in China. And it's much more than just PayPal or Visa or MasterCard. They've got money market funds, they've got insurance platforms, wealth management platforms, and as well as payments. China's got a very high penetration now of digital payments. You can literally use Ant Financial or Alipay as it's known anywhere in China, and now in 58 countries around the world. So that's another theme we've been after, but this is the Chinese way of getting it. Another big theme we're after is cloud. The number one cloud hosting platform in China is AliCloud, of course owned by Alibaba. We've been very interested in Microsoft and Google, who have large Western world cloud platforms. The number one cloud platform in China is owned by Alibaba. And then the last one I would mention here that Alibaba owns is really a platform they're developing for the digitalisation of enterprises. So as we moved through 5G, the Internet of Things, as we start putting smart sensors on many devices around the world, they have a vision with all of their intellectual property to start digitalising physical retailers, digitalising government services, digitalising entire cities, digitalising whole manufacturing processes. And I would argue that that digitalisation of the enterprise in 10 years could potentially be as valuable as the whole of Alibaba is today. And they're well ahead of where the Western world is on the digitalisation of enterprises. So Alibaba's not just about e-commerce. For very, very large growth platforms that they're developing, I would argue that there are maybe 4 incredibly powerful businesses in the world. We've talked about Alphabet many times, which of course owns Google, which has very, very deep intellectual property. Another one is Amazon that we don't own, is a very, very powerful and advantaged company with data and intellectual property, a massive cloud platform. Microsoft, I would argue, is a very, very advantaged company in the world with their cloud platform and their enterprise software businesses. And I now add to that list Alibaba. I would argue that these are the 4 most powerful businesses in the world today, with enormous growth prospects ahead of them. And Alibaba, I'd argue, is today and will be the most important business in China. And the last factor I'd say is, why are we there? Because we believe it's fundamentally cheap and mispriced at the moment.
And Hamish, it is your first investment in a Chinese business. How do you assess the political risk associated with investing in China?
It's a very good question, Frank. First of all, I'd say is when you get large, powerful companies that have massive amounts of data and have very high market shares, they tend to get have political risk and regulatory risk attached to them. So just because a business is in the United States, like Facebook or Amazon, there is a lot of political and regulatory risk associated with them. When they're global, you get taxation risk with them, you can get antitrust risk, you can get new regulations happening. And just because we're in China, we shouldn't assume that political risk exists in China. It doesn't. It is a very, very important and powerful company in China. So it's going to be very, very important to the government in China, and therefore carries risk. There is some risk around the ownership structure. Technically, foreigners aren't allowed to own technology licenses effectively in China, so they're held through something called variable interest entities. There's a risk around the ownership structure, so we have to take a view, will the Chinese government effectively outlaw the ability of foreign investors to own the tech platforms through these VIE structures? Obviously, whilst that is a risk and we have risk controls in our portfolio, we think it's very unlikely the Chinese government would shut off their most important company from global capital markets, which would be the effect. Effectively, China would shut itself off from the world by shutting its most important company that is currently nearly all owned by foreigners at the moment, of taking those property rights away. But that is a theoretical risk that exists at the moment. So we do it with risk controls, we understand it, we assess it, and ultimately we make a judgment call on those. But would we want all of our portfolio in Chinese technology businesses that have VIE structures? No, we wouldn't. But are we happy to have a modest proportion of our total portfolio in very advantaged Chinese companies that have enormous growth prospects that are undervalued? Yes, we are prepared to do that.
And Hamish, not unrelated, how are you concerned about the Hong Kong protests that are going on?
No, we're not overly concerned. Obviously, there's an enormous amount in the media. We see it. We see it every day. The biggest risk you have to think about is that sort of protest, democracy sort of push going to move into China, and are we going to see instability in China because of what's going on in Hong Kong? We would argue that's very unlikely. That if we started to see protests start in China, we would expect within China they will act on that very, very quickly. And they have enormous data and surveillance systems to identify that very quickly. And I think they could put those lights out very, very quickly. And therefore we're not going to sort of get a Tiananmen Square style event in China is our call. The ultimate call is how the Chinese government, the PRC, is going to deal with the issues in Hong Kong. At the moment, they appear to be playing a very measured hand, effectively let these things burn themselves out, it would appear to us, in terms of the strategy, not really moving the military in to do that. I suspect if a lot of people were starting to get killed from the riots in Hong Kong, that may be the guise where they could bring martial law in and order, they're just restoring peace and order because the rioters are actually killing civilians. But without an actual backdrop to bring the military in, I would be surprised. I have no idea, by the way, but I'd be surprised that would be in China's interest to be acting in that way, as opposed to just let this burn itself out over time to become a relatively small movement as time moves on. Are they going to give major concessions to Hong Kong and give them full democratic rights? That also seems to be a very unlikely outcome from Hong Kong. But is it causing us concerns that suddenly the whole of China is going to destabilise because of what's going on in Hong Kong at the moment? We think that's unlikely.
Hamish, there's an increased focus on the 2020 US presidential elections. Whilst they're a fair way away, how do you think they might impact markets generally?
Well, this is a very good question, and something that the macro group focuses a lot on at Magellan, to think about the likely outcomes. It would appear, sitting here today, and we've still got a long way to run, that there's three emerging candidates to be the next president of the United States. Of course, Donald Trump for the Republican Party, and the other two would seem to be Joe Biden and Elizabeth Warren are emerging as the candidates on the Democratic side of that. I would argue, in looking at today, that I think it's most likely that we either get Biden or Trump being the next president of the United States. That is not saying that I believe Biden is necessarily going to win the nomination from the Democratic Party. I find that too hard to call. But in a Elizabeth Warren versus Trump lineup, I would say it's very likely that Trump remains president, because I think his campaign will be very strong. She's a very progressive side of things. She wants to effectively nationalise healthcare, remove insurance, introduce wealth taxes, introduce a whole sets of regulations. And I think his number one call is, we're not a socialist country. And I think that would be a very, very powerful message. It's also, we're going to be flooded by Mexican criminals if she gets in. I think that will be a powerful message, and she may well be softer on China. So I think he's cards to play against her, and I do think people act in their self-interest. I think the progressives on the Democratic side would love Elizabeth Warren, but I think moderate people in the middle will not like the sound of what her agenda is, and therefore ultimately Trump has the upper hand in that battle. If it happens to be Joe Biden wins the Democratic nomination, I think that's a very interesting choice. I think it's much more even between Trump and Biden. We haven't yet seen their election platforms, but at the moment, but you could see moderates and independents weighing towards let's just have a reset here. Progressives on the Democratic side aren't going to really like Joe Biden because he doesn't have the deep sort of left agenda that an Elizabeth Warren would have. But at the end of the day, they really hate Trump, so they're probably going to vote for Biden anyway. And therefore the moderates and independents may well swing towards Biden. So if anything, I'd probably lean towards Biden. But we don't know who's going to win those nominations between, and it could be somebody else out of the Democratic field where we haven't actually really got deep into debates yet. We're very early on in the process. We haven't had the primaries yet. But most likely is we will get a Biden or Trump would be our assessment at the moment as the next president. And I would say for markets, both of those things are positive for markets. Trump has been absolutely positive for markets. Outside his trade war issues, the rest has been very pro-markets, tax cuts and deregulation and freeing the markets up. And I'd say Biden will be, while he's probably going to have more tax cuts, it will be, we're not going to have a radical agenda here. So it will probably be a period of stability, which the markets will like. And he may well have not quite as confrontational agenda with China. So either Trump or Biden, we would be relaxed from a market's point of view. If we're wrong and Warren gets up or Bernie Sanders gets up, that could be, and depending on how Congress and the Senate falls, which is another set of agendas here in the United States, that would be much more concerning from a market's point of view. But we don't put that early on in the process as the high probability outcome, and maybe why we're seeing markets being relatively relaxed at the moment around this issue.
And so, Hamish, would a Donald Trump impeachment change your view?
Well, that's a really good question, Frank. I think impeachment is unlikely because it takes 2/3 of the Senate, and therefore you're going to have to get a lot of Republican senators wanting to vote to impeach, and I would say that's unlikely to occur. But still, we don't know all the facts. But if that was to occur, that actually would change my view. I think if Trump was impeached, it would give a much easier pathway for Elizabeth Warren to get the nominee. To be the things. And without Trump sitting there, she may well have an easier pathway to become the President of the United States there. So an impeachment, I would say, would be negative for markets because it changes the games in forms of probably the more progressive Democratic side of politics, because people may well, I think, in the primaries at the Democratic side not vote for Warren because they actually think Biden has a better chance of beating Trump. But if Trump's no longer there, people may say, well, let's go for a progressive agenda because we have a shot now Trump's not there. So impeachment, bad for markets. If it gets through, is it going to happen? I would say to get that many Republican senators on board for an ultimate impeachment, I would put it as a long shot here. But you know, we're days into this at the moment.
Hamish, are markets overheated on the back of the central bank's easing of interest rates, or are we in an environment where rates are going to be lower for longer?
Well, first of all, I'd say I think we are in an environment where I think rates are going to be lower for longer. The question of whether or not markets are overheated or not really is a valuation question. And when you look at the price earnings multiple of markets around the world, in many markets these look elevated compared to long-term history of price earnings multiples. So some people would say that would be an indicator that markets are overheated. Currently, long-term bond rates in the world are 2% or less, but the markets are not factoring in they're going to be 2% or less. We have lowered our long-term bond rate assumptions. I don't want to say exactly we're nowhere near the 3%, but we are less than 4% in our long-term bond rate assumptions. And through those eyes, we do not view that the markets are overheated. That doesn't mean markets can't have cycles or we could have a recession, but the long-term valuation of businesses doesn't look stretched. Where this could be fundamentally wrong is if we get an inflation shock in the world, and this lower for longer interest rate assumption of what markets are starting to factor in is incorrect. We are not seeing many inflation pressures. In fact, we haven't seen it for a decade around the world. Many have been expecting it, and even in the United States, which is probably the most with the most accommodation, with very low unemployment, we're really not seeing a lot of inflation pressure, and we're certainly seeing none out of Japan, and we're seeing none out of Europe at the moment. But if we got inflation shocks and long-term bond rates dramatically increased, and let's say they went above 4%, and the long-term bond in America is closer to 1.5 than it is to 4 at the moment, but if it suddenly shot up to 4%, then we would see a meaningful market correction, we would argue. So we're watching inflation forces very, very carefully here. But your first question, are we lower for longer? Yes, we are. Have we lowered our assumptions around long-term bond rates? Yes, we have. Are we anywhere near current bond rates in our assumption of long-term bond rates? No, we're not.
And so, Hamish, given those circumstances, are you finding opportunities to deploy cash and make further investments within the portfolio?
Yes, we have. If we looked at the end of December last year, we were at 20% cash, and actually we changed our view that the US Federal Reserve was going to switch from tightening interest rates to effectively easing interest rates. So it was a fundamental shift, and we were going to move into a lower, for quite a period of time, interest rate environment, and we thought then in early January or late January the market was mispricing that. So as we were looking through that lens, we have deployed maybe 12% of the cash we were holding in the last 6 months or so into some very, very interesting business opportunities. We've bought a position in Estee Lauder, a position in LVMH, we've bought a position in Alibaba, we're now in PepsiCo, but we've bought some utilities in the United States. Some of it's been switching and others have been absolute deployment of cash, where in the world of this lower for longer interest rates and a lowering of our bond rate assumption has actually shown to us that there's been some very interesting investment opportunities. And we don't judge things in 6 months. Many of these things have gone, some haven't, but most of them have gone up in that last 6 months since we bought them. But we're really taking a 5-year plus view, and we do see some very interesting opportunities. But we've already deployed quite a bit of our cash, and we started, 6 or 7 months ago in deploying that.
Thanks, Hamish.
A pleasure, Frank.
And thanks for watching this update.